Hey, good morning, everyone. Marty Missouri here, March 30th, 2024, with your weekly economic update. I will spend a little bit of time on markets today. I apologize, I didn't get a end-of-week market snapshot out to you. However, I will tell you that the charts simply have not changed. At least look of the charts that matter to us, and those are the ones that give us an intermediate to longer-term view of the risk-reward setup. Having said that, I have made the case here of late that near term, and that would be over the course of the next few weeks, it would surprise me if we do not get a fairly decent correction, let's say in the 5 to 15% range. And I do anticipate that based on how I think the Fed's reaction to that would be, I think that would be bought up fairly aggressively in this particular market. Ultimately, as I've pointed out, certainly on the technicals, and I think in a big way on the fundamentals, and these are some of the things I want to get at just in terms of some of the underlying or overhead dynamics to the equity markets that are reason for continued concern here. Now, this is not an environment where, as cautious as I sound, we cannot make money. We've had a pretty good year so far, and our core portfolio had a really, really good March. But interesting that it wasn't all equities. In fact, probably the biggest driver of our March performance actually came from the commodities space. So having a diversified across asset classes across the globe with plenty of liquidity is the right way to navigate this going forward. So folks, as usual, in front of you is the graph of our PW index. We broke even, stayed a -9. We did have one input decline in terms of its scoring. We had another one that increased. Right now, of our 47 inputs, 26% read positive, 34% read negative, and 40% read neutral. Okay, so I'm just going to touch on 4 or 5 of our inputs and get to some data that I borrowed from various places, as you'll see, that I think are important to take in. So first of all, the PCE data came out. Personal consumption expenditures, those popped big, 0.8%. That is unequivocally positive in terms of what it says about the state of the consumer and the state of the economy. However, personal income only rose by 0.3%, and consequently, the savings rate dropped back down. So folks, clearly, as we know from the credit card data, we know from expenses versus income growth and so on, that people are spending their savings. They're probably spending beyond their means. We are seeing in the wrong places a pickup in delinquencies and things like credit cards and auto loans and so forth. And again, that's the sort of stuff we're looking at that says the consumer is feeling some stress. It's not horrible, historically speaking. You look at consumers in the aggregate, the levels aren't something that would have you losing any sleep right here on the economy, but it's not about the levels. It's about the direction, and the rate of change is really what we should be looking at. Consumer confidence, our two inputs kind of went in opposite directions, starting with the positive University of Michigan survey. Bounced by 2.5 points to 79.4. That's the best since July of 2021, although it's still below the February 2020 print of 101, as you can see, right before that blip of a recession around the COVID shutdowns. Inflation expectations ticked down, both short and long term, just barely. Expectations for personal finances improved modestly from the prior month. Perceived negative effects of high prices and expenses on living standards eased. In a nutshell, sentiment is pretty much unchanged. As for the less positive survey, that would be the conference boards, came in at 104.7, just below the estimate of 107, and they revised February down to 104.8 from 106.7 initially. Present situation was higher month over month, but expectations for the future actually declined, so they got a little bit pessimistic. One-year inflation expectations actually rose in the Conference Board's survey, as opposed to dropping a bit in the University of Michigan's. Labor market questions were mixed, and spending intentions were mixed. Okay, so not bad, certainly not horrible. People aren't closing their doors and staying out of the stores. But as you can see here, historically, these things can decline in a hurry. And I've said before, in terms of the consumer, we could see, particularly when you look at these delinquencies and lower savings rates and the rate of spending, we could see people kind of turn it off relatively quickly. At least that's been the case leading into past recessions, quite frankly. Okay, and then the inflation data. Overall, it came in as expected. Headline at, call it 2.5%, which was up just a bit from the previous month. And core was at 2.8, which was as forecast. Powell spoke yesterday. I caught some highlights from his interview. And he basically, said that nothing about Thursday's report was surprising to him, pretty much as expected. He says there's no rush to cut rates, but he does seem to give, I think, the impression, and I think on purpose, that inflation has been beat. It's just a matter of time. Nevertheless, he did talk about that early 80s scenario, which I referenced, I think, in the last 3 videos, which is a concern of theirs. So it's good to hear him talking about that. He said we want to be very careful, because if we cut too soon and inflation comes roaring back, that can be a pretty ugly problem, quite frankly. So it'll be interesting. This market, on my humble view, is utterly focused on what the Fed does. I mean, we've had just incredible expanse of valuation multiples. And when I say a market has been multiple driven, that just means that the price has gone up and the earnings and the cash flows just really haven't kept pace with the price. So there's a lot of optimism priced in there. And I think it is in anticipation of the economy weakening, but not too much, and the Fed accommodating with lower interest rates, which justifies these higher price to earnings multiples, for example. But my goodness, the earnings just have to happen. And in a slowing economy, of course, that says something not so positive about the prospects for earnings. So I think the Goldilocks scenario is priced in, and that is inflation coming down, landing softly at that 2% target, and everybody just keeps on chugging along. Hey, anything's possible. I can point to the mid-90s scenario and say that actually indeed happened. And I can also point to massive discrepancies between the macro underlying setup then versus now as well. So for what it's worth, mixed economic results. We're still a little bit in the score in our index that says recession odds are too high for comfort going forward. It has gotten better of late. We'll see if that continues. And I'll talk here in a minute about the problem for markets, equity markets in particular, and bond markets, if it continues to get better. Okay, so let me just pull over my little cut and paste screen right here. And I'm going to give you some commentary from macro experts who I have a lot of respect for. First one, gentleman named Eric Basmajian. He points out that the Philly Fed publishes coincident indexes for all 50 states. The January update showed that 34% of states now hold a 6-month growth rate below 1%, the highest percentage of this business cycle. And then he shows a chart. These gray areas are recessions, folks. And you can see what tends to happen with this particular statistic prior to recessions. And he's concerned because this is where we sit right now. Julian Brigden, another one of my favorite global macro experts. It's our view that far from just right, Goldilocks porridge, speaking of Goldilocks, is too hot. Hence, outside a couple of tweaks, rate cut expectations are delusional. Is Waller, he's a Fed governor, the first sign that the Federal Reserve is pushing back? Will Powell follow tomorrow? He said this on Thursday. Or are we heading for FOMC descent, which is what they don't like, and that is where, for example, Powell says we need to cut 3 times this year. Folks like Waller and Bostic say, crazy, we're not voting for that. So we'll see. I do sympathize with Brigden. I think the data do point to that. There is this camp out there. I cited a couple of people I have a great deal of respect for last week who think that there's not a recession looming and that inflation is going to be a real problem. We still think that there is recession looming, even if it's on a 6 to 12 month outlook, and that we need to be very cognizant of that risk, but open to all possibilities, of course. Craig Shapiro, core PCE comes in at 0.26 month on month, rounded to 0.3, confirming what Powell said at the press conference. However, January was revised higher to 0.45, rounded up to 5. You could argue that the price momentum to start the year was even stronger than expected, and we are simply slowing down from that seasonal strength, but we are still annualizing at rates higher than the Fed's target. And this is the data that the hawks, those who are really concerned that inflation is going to run away from them on the Federal Reserve Board, this is the data that they worry about. Bob Elliott used to be with Bridgewater. Now he's with, I think his fund group is Unlimited Funds. Really, really, really sharp guy. He was pretty spot on all of last year, against the grain pretty much. Today's data on wage growth, inflation, and spending is a step back to the Fed's shift to easing. Each is a little too high for the Fed to think either inflation is beat or the cycle is turning. Nominal wage and salary growth pretty stable at elevated levels. Likely implausibly strong this month, but either way, a concern certainly not giving confidence that the underlying drivers of inflation are beat. Those are concerns if the market is discounting, 3 rate cuts this year, first one in June, and it may very well get it, but there is some risk to that narrative. Peter Berezin, who was spot on last year, he was not in the recession camp. He was kind of on an island out there by himself, he and his team. He does say higher odds of recession second half of this year, first part of next year. He talks about that personal savings rate. It dropped to 3.6% in February, half of what it was in 2019. But with consumer credit growth slowing and excess pandemic savings likely exhausted, consumers will have no choice but to tighten their belts, and my concern is that they begin to do it all at once, like I just charted for you. We are exploring another potential partner in research, MRB. Really, really good presentation that we spent 90 minutes on the other day, and I've reviewed it again. And now we are in a very different camp in terms of they just absolutely don't see any recession risk. They think those of us who are concerned about it really don't get the bigger picture. One thing we do agree on, though, is that we are very late cycle. Now, they're bullish on the economy. They are, quote, cautious on the equity market. It's just gotten way too far out over its skis. And here it shows, the global stock to bond ratio. And we look at such things as well, as I've illustrated for you. And you can see where it was, before the tech bubble burst and before the real estate bubble burst. And these were crippling stock market bear markets, by the way. Look where it is now, right? The unemployment rate, you tend to move in the wrong direction and you end up in recession very, very quickly. We've talked about that a lot over the years as well. This concerns them. Global return on equity beginning to roll over. While again, this market could continue to melt up, notably from here. I'm not at all dismissing this possibility, but truly little scope for further equity market relative re-rating versus bonds, which was that top chart. So basically, his point is that there's very little potential for durable upside in this market. A very high hurdle for U.S. tech earnings. Couldn't agree more. 12-month forward PE ratio is at historic highs, right? As our price to sales ratio, that one concerns us more. And I've shown you that here recently, that we are just beyond where we've been historically, and that should be something that has people's attention. Now, as I've illustrated as well, so we agree on a lot of things. Massive divergence between U.S. and ex-U.S. equities. We think there is massive potential outside the U.S. For lots of reasons. We're going to have to be selective. There's certain areas that we like more than others. We are already expressing some of that in our core portfolio. Just something I pulled over from the Financial Times. I tend not to get too excited about insider action. I think people get, they leverage that when they want to support their narrative in one direction or the other. Apparently, however, though, folks like Peter Thiel, Bezos, and Zuckerberg have been selling quite a bit, and according to Financial Times, a parade of insiders have sold hundreds of millions of dollars of their company's shares. The ratio of corporate insiders selling to insider buying is at the highest level since the first quarter of 2021, and we know how ugly 2022 was. But, people sell their stocks for different reasons. These people are unbelievably rich, and, pulling $100 million here or there isn't such a big deal. But apparently, it has the attention of folks who track this stuff. There is reason to think that this could be a red flag. You can see the sales for Thiel, Bezos, 50 million shares worth $8.5 billion of Amazon. That's a big deal. Amazon's chief executive sold 21 million worth of his stock this year, compared to a little bit more than that in 2022 and 2023 combined. Zuckerberg, he's been a seller for years, but he's increased his selling this year as the stock hit an all-time high. And let's see, lastly, within the tech sector specifically, we're seeing a number of big company names in this space with insider selling that is not typical. Clearly, there's an appetite for liquidity generation right now. Insider sales by high-level execs of large amount of stocks are never a good sign. It means they have found a better place to deploy their assets than the businesses they're running. None of the companies were interested in commenting, of course. Okay, so almost to the end. Bob Elliott again. Today's market cap concentration in the top 10% is the largest U.S. stocks have seen, and they've only been that high in one time historically, and that was the wrong time, 1929, right? And now, just, valuations are terrible market timing tools, easily could break all of these records, but you just tend not to have good extended performance beyond periods of these kinds of valuations. And John Hussman, who does a really deep dive, excellent work on lots of things, including valuations, he's quoting himself from March of 2000, at the beginning of just an epic bear market, particularly in all things tech. The market is in a two-tiered frenzy between new economy stocks and old economy stocks. Anyone who has studied the concept stock mania of 1968, 69, Nifty 50, mania of 72 has to be getting chills here. We've seen two-tiered markets before, most prominently in 29, 68, 72. The inconvenient fact is that valuation ultimately, and ultimately can be a long time off, folks, matters. That has led to the rather peculiar risk projections that have appeared in this letter in recent months, and he's doing that again, I can tell you, because I read all of his letters. So, and here he is on his most recent letter. Based on valuation measures we find best correlated with actual subsequent S&P 500 total returns across a century of market cycles, the market presently stands at valuation extremes matched only twice, December of 2021, right before the 2022 bear market, and the bubble peak in 1929. While our investment discipline is to align our outlook with prevailing observable market conditions, investors are presently enjoying the double top of the most extreme speculative bubble in U.S. financial history. I'm not going to say that I'm completely on board in terms of what that would look like on the other end. I do think we are in a new regime. I do think that the Fed will step in aggressively with more firepower than we've seen in these previous bear markets. COVID set the stage for this. But you can't be too optimistic about long-term results from these valuation standpoints, and you need to be guarded against something precipitous to the downside when you combine this with some of these other things we've been talking about. And he speaks to these other things, other measures of market internals, which tells us that we should be hedging right here. Present valuation extremes might only or otherwise be a long-term concern if our measures of market internals were not also divergent and unfavorable here, right? It's always popular to imagine this time is different, and I think it is, to the extent of the power that can be brought to bear, the firepower, right? I do think this Fed, for example, and the Treasury as well, will panic in a decent double-digit market correction. Our base case is in a garden variety recession, and that's no reason to think it would be much different than that if we have one in the next 6 to 12 months. Says stocks, when they do what they normally do and what earnings normally do, are 40 to 50% overvalued right here. Before we get there, I think the Fed unleashes a massive amount of support like they did around the COVID hiccup, right, which was 35+% over a 3-week period. And they broke all the rules, and they needed to rescue the economy, and they couldn't let the consumer crash and burn this time. We are very much in a new populist, labor-friendly regime. So I do think markets get rescued sooner. But here's the rub, folks. You can't continue to do this under the regime I just mentioned, because the regime I just mentioned is an inherently inflationary regime. If you continue to come with liquidity every time something begins to break, you are not ever in our lifetime probably going to see inflation down to where you think you need it to be. Now, having said all that, here's the interesting part. When you're looking at 130% debt to GDP, you actually need higher inflation. And I've written a lot over the last 2 or 3 years, and I've mentioned it a lot, the 1940s narrative. The only other time we were north of 100% where they implemented yield curve control, which is where they capped the yield curve on treasuries, allowed the government to reinvest, in that case, all that war debt at lower rates, lower than the inflation rate. So you inflate the economy faster than you inflate the debt, and you wake up, in that case, 8 years later, and you're well below 100% debt to GDP. A higher inflationary regime, a weaker dollar environment, we think will be the case on a trend basis, opens up all kinds of value globally that we intend to be here to exploit. Thing is, again, we're late cycle right here. There's more to play out right here. You can get a little too anxious. You can get a little too impatient right here, and you can make potentially a big mistake. I don't know that that's how this is going to play out in a big, precipitous downdraft in what a lot of people own. I suspect it probably will, but like I said, I suspect that the Fed will try more mightily than they ever have historically to circumvent that. The history has been that as they try, markets continue to dip, and they're being aggressive because they need to be, but the market needs to get to some fundamentally better place. And we think that's, again, 45% below current levels in a garden variety recession. John Hussman actually thinks it's further than that. I think that we will probably begin scaling in before we get to either of those because of what I've just mentioned about intervention and so on. I'll leave it there, folks. Thank you so much, as always, for watching and listening. Bye-bye.